People tell me they trade chart patterns all the time, but I see them doing it wrong, and I see them like not having the right rules or learning from a crappy site where like the rules don't make any sense. What's up, traders? Welcome back to another video in Hanoi, Vietnam. So I want to show you in this series how to trade chart patterns. We'll look at multiple of them over the next few weeks. I'll have a video like this once per week for you guys to learn how to trade chart patterns, and we'll go through different examples, of course, on live charts. This week we'll cover the double top, double bottom. Those are the same thing, they just apply to different markets, so bullish or bearish. You gotta be able to figure out what these are, how to trade them, and those patterns are especially good to trade by themselves, which means that you won't need too many indicators. In fact, you won't probably need any of them. That's gonna be fine. So you can look at the chart, trade price action only with those patterns, and that makes sense. So I want to go on the chart and I want to show you guys how that works and how to look at those patterns, what to trade them for, what rules you should have, what things you have to look at for sure. And you guys can leave in the comment below, as always, your thoughts on this. Also, don't forget to subscribe. There's one more video like this every single day. And I'll be here to help you out along the way to make sure you get some result. So let's get on the chart. Alright, so here I have an example on AUD/USD. We'll look at this one for today to learn to trade double top and double bottom. Now, the first thing people will do wrong is the fact that they will look at this chart and immediately look at the chart patterns to try to find the double top, double bottom, try to spot where to buy, where to sell. But that doesn't really work well. So the first thing you want to do is you want to find out a bit of background about the pattern you trade. So what that pattern is for, when does it work, and you also want to find where the market is right now. We call this the market context. If you find out the context first, then you have a much better chance of succeeding. So the context comes first. And here on AUD/USD, you see that price kind of goes between two zones, two major zones. One is at 0.80, so a round number, in Forex, and the other one is at 0.70, so again, a round number. Now, in between, we have the zone at 0.75. You could also trade that if you want. It's kind of an intermediary zone, totally fine to trade. But you also want to look at these major zones as well. Okay, now price comes back to a support here at 0.70, where we want to look for bullish trades. Price reversed there a few times in the past. Now, it doesn't mean that's going to reverse again here. Okay, keep in mind we're on a weekly chart now. I tend to look at my context on a bigger time frame because it's just easier that way. And then we'll go deeper into the shorter term time frames. Okay, so we start here, and you could do this on a daily chart or weekly chart. Let's see if we look at the daily chart. You're gonna get something similar. So this here could be a support. You get the same numbers, so 170. Although now we are lower, but we're still in the zone if you look at the bigger picture over here. So we get pretty much the same thing, except we'll have some more zones in between. But let's say we go to the weekly chart to make it simple. We are on the weekly chart. We look at the zone, a bullish zone, to look for bullish trades. And now we say, well, okay, so we need to look at chart patterns, but we won't trade them on the weekly chart. You could do it if you want, but the weekly chart is going to take a long time for your trades to unfold and to finish. So ideally, you want to go on lower time frame and look at this time frame for trades and for chart patterns. So we could go on the forward chart. We could look at pattern here. We'll see that price kind of came back here reversed. So the good thing about these lower time frame is that we don't need such a big move than the weekly chart to make a profit. Just a small move, even if price were to just reverse temporarily and fall back down after, we can still make a living from this. Okay, that's totally fine. So we will go on the 1 hour chart for this example and kind of see what happens with this. Okay, I'm just going to scroll back where price reverse, and we'll do two examples. One setup that people would take, that's wrong, and one setup that people would take or would not take, but that's the right setup to take. Okay, so two examples of this. So now price comes back here near the support at 170. Okay, comes back up a little bit. We get this kind of move here to the upside, which we're not going to talk about. And then price comes back over here, does a low, pull back up. Okay, I'm just going to kind of scroll so it's easier to see kind of like in real time. Price pulls back up. Again, goes back down, and here we have what we call a double bottom. So a bottom here, a bottom here. We'll just need to make sure these are going to be equal, and yes, price comes back up, we get the double bottom. I'm just gonna draw this over here so it's really clear. So bottom over here, bottom over there. Okay, double bottom. Now this is pretty good. So people know for a fact, because they've heard like baby pips, they've gone on different website or they've watched different videos, they know, oh, double bottom, I need to buy. So people are gonna buy here. Okay, let's see, buy here, and then they're gonna wait, and price gonna reverse in their face. Okay, and they're gonna be stopped out. Now this is the example that people would trade. Most people would trade, in fact, because that's how you learn online. But it's not how this works. Okay, so you gotta be more smart than this. And that's why I want to kind of do this series, because people always do this wrong. And I need to point this out so you can do it right, increase your win rate, get a better trading strategy with this, and hopefully make a profit in the end. Okay, that's like my ultimate goal. So here's what you want to do. We'll take this over here, and you need to figure out where to enter. That's the first thing, and then what to put your stop loss. But we'll go with the entry first. Okay, so entry goes, and I was just gonna draw this over here. Okay, so now we get these zones. This is the double bottom. So we'll put a line over here. Now what you want to do is after your first bottom, right? Price gonna reverse a little bit because you need to have a second bottom, of course. It's gonna go to a high, come back down to your second bottom, and that's where you want to put your kind of box. Okay, so I'll put it here where you have the wick. And basically what that says is that you will be entering the market beyond that point, okay, beyond that zone. So we make a low here, we push up, make our high, come back for a second low, okay, second bottom. And that's where you would draw kind of your, we could call it neckline or just like resistance area, whatever you want to call it, it's fine. But that's where you would enter the market, beyond that point. Okay, so the entry would be here. Now you will get two choices for your stop loss, and I give you two choices because it depends on your personality, what you prefer, and you pick the one you want. Because the first stop loss is we're gonna put it beyond the low, so maybe not that far, but maybe like just over here, okay, beyond the low. So we get this stop loss. That's really conservative. Okay, price would have to really kind of go from here to here, big move. So really conservative. Now the second stop loss we have would be, we'll put the stop loss just beyond or below the candlestick breakout of the range. Okay, so now here it didn't break out, but in some examples it's going to break out, and you'll see how that works. Okay, but that would be the second stop loss. Less conservative, more aggressive, but it depends on what you prefer. Okay, for me, I tend to prefer this one over here, even though I'm more conservative as a trader, and I would tend to place it there. In that case, it's just like too big of a stop loss. You would have to have like a really big move for this to make money. But here, it's like you can go 2-3 to 1 easily on that trade if your stop loss is more aggressive. Okay, so you decide. Now take profit. There's a rule that says that, and it's just like a rule that's been probably made up, like no one calculated that, I think. There's many ways you can go about it. The first one is to use fixed take profit. We'll just put it here. Fixed take profit. Okay, first rule for your take profit. The other one is going to be to use the range. Okay, so we'll put RA for the range. And so what does that mean? Is that, so let's say you put your stop loss here, you'll be looking at this tool over here on TradingView. You'll put this right there, make your stop loss, and then look for a fixed take profit of like 2 to 1 or 3 to 1, or take partial profit. So let's say we do 2 to 1. Okay, that's around here. Now we get 2 to 1. You could do 2 to 1, 3 to 1, multiple take profit. I would prefer multiple take profit, but that's just your call. Okay, you decide what you do on that trade. Now the other rule, or the other way of doing things, is you look at the range and you basically add this up on top of your entry. So let's say that you go from this range over here. Yeah, that's our range. Like this. Now you would add this on top of the range, and that would be your take profit. So this would comes down to like around here, and you basically add it after, like beyond this line over here. Okay, so this would be our target, and that will be like where you go out of the market completely. You could go and do partial take profit in the meantime if you want. That would be awesome, but that's just how things works as basic. Okay, I tend to prefer this way over here just because it's kind of more simple and more straightforward. This one needs more calculation and stuff, maybe more risk for error sometimes, but you decide which one you prefer. Just two different ways of taking profit. Now that's an example that didn't work. Now I'll go with an example that worked. Or actually this one you wouldn't take it. Like you would stay away from the market in that case. But what does that look like if it works? So price comes back down here more in the zone. does this low over here, came back to do this second low over here, so the same low again. Okay, pretty strong. First low, we get a big gap, second low. And keep in mind this, it's gonna be our neckline, right? Or resistance area, whatever you call it. Now price, okay, messes around a little bit, does a third low. So triple bottom, it doesn't really matter, who cares? Price goes up. And now, did we break off that zone? Well, we could say yes. But price just goes around and messes around, goes sideways. And then breaks again over here. Okay, so this one over here is the strongest one. Now, depending on your rules, I would prefer price closing like far beyond and not just small candlesticks. But basically, so here's what you see. So price broke, okay, and now you would have a couple of different ways of entering the market here, and we'll go to that. Okay, so first of all, we'll just put this over here. Here's our triple or double bottom. Okay, here's our neckline, and I'll just make sure that the wick is included in that. That's perfect. Then what you would decide is you could enter here. Okay, you can put your stop loss either below over here or below candlestick get broke out over here where you'll be probably stopped out. Although this one like is really not strong, not breaking out strongly, so you could even avoid that trade. Okay, but let's just say that whatever, you enter the market here. Okay, you enter the market, put your entry just a little bit beyond. Okay. Put your entry just a little bit beyond, so let's say here, and let's say you're triggered on that trade, okay, because we just don't care. Now you put your stop loss, say over here, you're stopped out. Okay, what if you put it below and be more conservative? You put your stop loss below over here. Okay, now you're not stopped out. Or what if you could also use like Fibonacci if you want to put your stop loss, or there's many different ways. Basically, if you put it here, it's totally fine. You would have to maybe re-enter later because you stepped out, but price still stays in the range, which means that you can still trade on that pair. Now the question is, so right now it would be beyond the high. Okay, so now the thing is, price falls back down, does a sideways market, and we get here, we don't break, then we come back here, then we break over here, and it's more strong. Okay, so if you've been stepped out, I would re-enter here. That's just how I would do things because we've been sideways, we didn't go like past the low, so I would just re-enter the trade. Okay, and you put your stop loss below the candlestick that broke out over here, something of the sort, and that's where you have your big trade. Okay, so now price shoot up in a direction, which is what we want to have. Okay, precisely. Now, two different ways of taking profit on this, like we talked about before. The first one is to look for multiple take profit and fixed reward to risk. So basically you would put, let's say we go here. Just gonna do an example. This one is see, so this one over here. Now you could do this. You could double that, so we'll make sure that we have a close to like 2-to-1 on this. Actually 1-to-1. A little bit less. Okay, that's like double this size of the range over here. We double it above. That will be a take profit. Okay, so we'd be getting 1-to-1. That's really tight because like you only get 1-to-1, which isn't much. The other way if you've been more aggressive is you put your stop loss like somewhere here. First trade you're stopped out. That's fine. Second trade you want to enter here. Put your stop loss below candlestick that broke out of this area if you're more aggressive, and then that's where you look for your major profit. Okay, so look, price went like what, almost 5-to-1 in their favor. Okay, so pretty big trade, but you'll be stepped out once, so you lose one of reward, but then after that you gain like a couple of reward. Okay, so depending on what you prefer, 3-to-1, 2-to-1, 4-to-1, I'll go with like multiples, like maybe 1 at 1-to-1. Maybe even you could do a thing where you move your stop loss to break even. So let's see, we'll get to 1-to-1 on that trade. So that's around here, and it's gonna work well here in that case. because we are in a breakout. Okay, so we break out of the range. Hence why when we break out, we're not likely to come back to the range. Okay, we might come back, but we might not come back. So it's a good place to move your stop loss to break even. So say we reach 1-to-1, move your stop loss to break even over here, no risk, and then you can go all the way to like 3-to-1, or find a way to trail you take profit. Okay, I would for myself put it at like 2-to-1, somewhere around here, and I would do 1-to-1, 3-to-1 perhaps. Or you could kind of decide what these numbers are and what are the best number for your pair. Okay, that's going to depend, of course. So there's no clear rule for everything. It's like find out what's the best for your pair and just do that. Okay, so you're going to have to test it out and see. But I really want to stress the fact that you need to look for an entry beyond the neckline or the support or the resistance area over here. Okay, if you just like enter right over here, it might not work, might fall back down, and then you get trapped out. So really important. And the other thing is like where you put your stop loss take profit. Those are important. So don't put it like just too far. Don't put it too close. Put it at a place that makes sense. And decide if you want to be more aggressive or conservative. There's no right or wrong answer. One is going to be stopped out more often, but with bigger reward. And the other one's going to be stopped out less often, but with much smaller reward. Okay, so you decide. That's your call. I'm just showing you what you can do and what you have to go through and stuff. And you're the one responsible. You're the CEO of your trading business, and that's your job to decide what you want to focus on. Okay, so hope that makes sense, guys. This is the first video in the series on how to trade chart patterns. There's going to be a lot more to come, a lot more in depth, and we'll go through different chart patterns. But here's one you can trade like right now if you want. You use this at your own risk, of course, and you gotta test it out first on your own because you are responsible, of course. So let me know your thoughts down below in the comment section. As always, subscribe if it's not done yet. And I'll catch you guys back here tomorrow for another video. Ciao.